when I started in this industry, in the financial industry, I had no idea how much to invest internationally. And what we're going to talk about today is what I figured out. Hi, I'm Bridget Sullivan Brown. I've got a fee-only financial planning practice in Chicago, Illinois.
And I'm John Shearer. I've got a fee-only financial planning practice in Middleton, Wisconsin. And before we talk about international investing, I want to remind all our viewers to hit that subscribe button. It helps other people find this information and helps our rankings on YouTube. And with that, I'm interested in your sort of the discovery process, Bridget, and where you came, how you came out with things. I know what I do with my international investing, and I think it's gonna be a really interesting discussion. And for me, I've been around a little bit longer, right? So it's hard for me to think back on that. I love the idea of, hey, when you first started, you can remember distinctly, all right, how I came about with this. Tell us what, how that evolution was for you.
Well, one of the reasons I got in the industry in the first place is because I went to a financial planner who, when I was asking her how to invest, she was like, "What do you want your asset allocations to be?" I'm like, "You're supposed to know that." Anyway, so figuring this out, I did a lot of research and tried to figure out how to figure out the industry. The first thing is, do you want to be an international at all? And because it can seem scary and frankly foreign, right? But when you look at the statistics about the foreign markets over time, you kind of want to be in, and the ideas about having a well-diversified portfolio. They won Nobel prizes, and it's really compelling when you actually get into the stats. Like, okay, the more diversification you can get, the better. And I think that really came home when I started working with dimensional funds or dimensional fund advisors. And that was really what they said is like, invested in like all companies. And but they do sort out, we have certain specifications that we do like for a country. Do they have property rights, for instance, so that things like that, basic functional economy, we can count somewhat on this country standards. And then they invest in the stock market at what's in the stock market. Okay, great, we'll invest in it, and we're not gonna. And they also invest in the proportion that so they invest in a proportion. So if Apple's a bigger company, then they invest more Apple. If that's bigger than all of some other country, that's okay. They just stick with that. And so I found that I try to track the actual companies in the world and in my portfolio, and I use the same percentages as they are in the world. So if that changes, so I try to have some objective measure for how to invest too, so that I can say, okay, should I be changing this? And what I found is that 40% in international and 60% in US, that's what dimensional shows is like, that's the number of companies in the world. That's like all the companies in the world. That's how it breaks out. 60 US, 40 international. So that's what I stick with.
Yeah, no, that's great, and I use dimensional funds too, and believe in some of those things. You made me think of when I first started doing this, 1,000 years ago, and how I came up with that was in a similar path. But it's interesting that there's studies that show that whatever country a person lives in, their bias tends to be investing in stocks in that country, right? And I remember the study was, Canadian investors generally have 40% of their money, 50% of their money in Canadian stocks, because that's what you know. And when you take a look at the world economy, Canadian stocks account for something like 3% of the whole economy in the world, right? So it's this idea of, geez, I know US companies because I live here and do these things. These other things seem scary, as you just described. And you go, well, wait a minute, just that's not necessarily the case. I'm going to pull up a graphic here from Dimensional Fund Advisors, and I really love this thing. It's laid out from left to right like a map of the world, like a flat map. There's North America over on the left, and Europe going over into Russia and Asia, right? But the sizes on here of the different sizes of these boxes correspond with how how much part of the world economy that country is with their market capitalization and their companies, right? And that's the one thing I just wanted to edit maybe a little bit. As I heard you say, it's not that there's 60% of companies in the U.S., but 60% of the world capitalization, about world investments, are in the US. And you can kind of see down here, I'll show you in the bottom left, they break it out into the US on the left, developed countries there in this sort of yellowish box, and then emerging markets countries in that greenish box over there. In the US, right? I mean, was it say 59%? I think, 60% is in the US and 40% is overseas. Our portfolios run really similarly to that as well. And this idea of, and you just described it, like we want to spread these things out because we don't know who the winners are going to be long term with things. So you go, listen, I don't want, and we've got folks that come in even from other advisors, and they have, 80 or 90% of their stock portfolio portion is in US stocks. Again, it's what we know. They're the the biggest and the baddest companies, right? And you go, well, wait a minute, look at this map of things. Look at where that allocation is. And golly, I don't think we want to be too US focused on things. There's one little piece here. It shows Apple. I think it says 2 trillion. That's how big Apple is whenever the date is on this, it's this year sometime. And look at that as we look at that big map, maybe side to side, right? Apple, the market cap of Apple versus, everything that's over countries in Europe, right? And this goes back maybe 10 or 15 years. Remember, Greece was having a problem and defaulting on their debt, and it was a big issue. And you look at the size of Greece compared to the size of Apple, and you can fill in some other of the big stocks in the world, and you go, wait a minute. On a scale basis, it's sort of interesting taking a look at what's out there, and what's not out there with things. The other thing I wanted to point out before we move on is just down this bottom left corner here. It shows, 59% of the market cap in the US or market cap in the world is US stocks, but it notes the number of companies there. Just take a look. We got, a little over 3,500 companies in the US. In those foreign places, you add together emerging markets and the developed countries, 15,000 companies, right? And so you think, US companies tend to be larger, and you're investing in, when we don't know which ones of those companies will play out and be the winners going forward, right? You just don't, we talk at our clients about, geez, I wish we'd invested in, Google or Microsoft and, Internet Explorer. Those, I said, yeah, but remember back in the 90s, it was Netscape was one of the big browsers, right? It was Ask Jeeves was one of the major search engines, right? If you didn't know that Google was going to be Google back then, you could have invested in a bunch of different things. So spreading that out makes sense. So, this reminds me as we're having this conversation, I'm like, I'm going to bring up this map. We don't talk about this enough with folks, but this is really powerful for me anyway, to say, listen, we want to be invested. It's a global economy with things, and investing in a similar fashion. We've always done it, but this really hits home for me.
Well, John, I want to pull out a couple things from what you said. One is that sometimes you see portfolios that you get, like people start working with us and we look at the portfolio a previous advisor had. And most times it doesn't have that much international as we go with. But sometimes it's because they're like, international's down. Why do I invest in that? And that's exactly what we don't want to do. We don't try to say, okay, is international up or down right now? Are emerging markets up or down right now? Because they go up and they go down, and even the crazy PhD people that have so much knowledge about this stuff can't figure out any kind of pattern. It's
Yeah,
like
right.
they go up and down in a random way. So you can't, just the way to make money on it is to have as broad a distribution as possible. So that's that's one thing I wanted to mention. The other thing is about emerging markets. So I think emerging markets is somewhat of an acquired taste because you're very volatile. So what we typically do with emerging markets is, again, we use the same proportions, and they're not that big of a proportion of the entire capitalization. Because when we think international, a lot of times we think emerging markets, but a lot of international is really like nested, and like big brands that we use anyway.
Yep.
They're now, they're based in, I don't know where Nestle's based in, but like I associate with Switzerland. This is Christmas, but I don't know.
Yeah.
Anyway, so we've got, that I think is a, something that people don't realize about international is that it's not, that doesn't mean emerging markets. I think emerging markets, we invest about 9 or 10% of
Same here.
the portfolio in that, but the equity part of the portfolio in that. But it's sometimes people say, I don't want international, it's too risky. And I would say, okay, take the emerging markets part out if you really want to ditch something. Because that is more valuable again, but again, when it's up, it's really up. So and we do special things with it, like try to put it in the accounts that don't have any tax. So when it grows a lot, then we can capture that and not be taxed. That's just an extra little tip outside of the context of today's show. So
You reminded me of, I just want to throw in one thing before we wrap up here on that idea of emerging markets. And this goes back 20 years or more. I was at a conference. So the data is outdated, but the concept is the same. And this was late 90s, early 2000s. And this presenter was talking about emerging markets and specifically in China at that time. And he said that the previous year, that if every resident of China would drink a 6-pack of Coke per year, in the next year, so one Coke every other month, that would have taken all of the Coke that was produced in the entire world the previous year would go just to China. Right?
okay.
So if everybody had one Coke every other month, all the world's Coke would go there. And the point is, you think about some of these emerging economies where there's so much potential. Yes, there's a lot of risk, right? But man, when things come in, the amount of growth that's possible in some of those places, it's a really powerful argument for saying we should have at least a little bit of money there to take advantage of some of that growth down the road. So anyway, with that, I'm John Shear, and I run a fee-only financial planning practice in Middleton, Wisconsin.
I'm Bridget Sullivan. I've got a family financial planning practice in Chicago, Illinois. John and I are both members of the Alliance of Comprehensive Planners, or AC, which you can find at acplanners.org, which is a national group of tax-focused, fee-only fiduciary financial planners that work comprehensively. And if you are interested in finding a different advisor, but that's in your local area, you can check out acplanners.org.
And don't forget to hit that subscribe button.